Welcome to Deloitte's Debrief Tax webcast series in Asia Pacific. Our webcast today is from our corporate income tax series and is titled Post-Merger Integration from a Tax Perspective. My name is Scott Olson. I'm a tax partner in the Seoul, Korea Deloitte office, and I have the pleasure of hosting today's webcast. Today I have two other speakers with me, Joe Song and William Lee. Joe is a tax partner in our Australian practice, and William is a tax director in our Hong Kong, China practice. You may access our bios on the left-hand side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are in listen-only mode. If you have any content-related questions, you may submit it at any time in the Q&A box at the bottom right of your screen. We'll do our best to respond to questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides or related publications, please go to the Download and Links box. On the other hand, mobile device users can view the slides and answer the surveys on their screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with a CPE certificate after watching for 50 minutes. Moving on to the agenda today, we will start off with discussing some of the tax strategies that can be obtained, or synergies that can be obtained by participating in cross-functional integration teams. We'll discuss tax planning with respect to divestitures, including carve-out financials. We will then move on to evaluating IP, value chain and supply chain planning, as well as transfer pricing, and finish up with legal entity rationalization discussion. Time permitting, we also have question and answers at the end of the presentations. So as we all know, combining large companies requires a highly coordinated process where each business function, such as manufacturing, finance, HR, IT, etc., must develop their own day one readiness and end state integration plans, and they must also collaborate extensively one with another. Businesses often disregard the tax department and the related tax opportunities and pitfalls associated with each area of the integration. While the particular tax opportunities and pitfalls may vary, there are two generally constants. There are almost always tax considerations in the other functions integration plans, and second, the time is of essence to identify and act upon those considerations. The extent to which the tax department is a regular and active participant in the strategic decision-making processes varies from company to company. However, a merger or acquisition may present an opportunity to elevate the perception of the tax department further. More importantly, active tax department participation in the integration can have a significant impact on the overall synergy realization. Once the deal is announced, most companies will have their integration teams quickly running at top speed in order to expedite the realization of the already announced and anticipated synergies. Accordingly, step one is to identify the key constituents who are managing the program and present to them the business case for active tax department participation. Step two is to identify tax resources that can be fully dedicated to the program. And step three is to analyze the investment of your department resources in the integration program. Meeting the goal of a proactive participation by your department could be impaired if the individuals that are assigned to the integration team also have to spend 40 to 50 hours a week on tax provisions or other operational support duties. With proactive and regular tax department participation, you can help the company explore ways to enhance previously announced synergy estimates. This will bring us to our first polling question of the day. The question is, what has been your involvement, the tax department's involvement in the post-merger integration process previously? Your options are fully involved with the other functions in the PMI process, provided input on tax matters only, but not part of the overall PMI team, not involved in any process or PMI process, or not applicable. While we're waiting for the results, question we get often is what is the level of M&A activity within the region? So Joe, let me quickly jump to you and see how are you seeing the M&A level activity in Australia?
would say the M&A activities largely held over the last 6 to 12 months. I don't see a huge decrease. There's probably a little more focus on cost savings and not paying too much, maybe more so than in the past.
Okay, William, how about Hong Kong? What are you seeing in Southeast Asia and Hong Kong, China market?
Yeah, I think what we have seen is I think in Southeast Asia, the M&A market is still very active. But obviously, because of the Chinese government strict COVID restriction policy, so China and Hong Kong has a little bit of really a slowdown of M&A market in the past year or so. But I've seen there's some M&A activities picking up by end of the year. So hopefully next year will be more active. And I see Chinese government and Hong Kong government are both revisiting their COVID measure. So there are some good news in the past few days. So hopefully next year the M&A activities will be picking up again.
Great, thank you. That's also what we're seeing in Korea and North Asia. Some shopping because of the currency devaluations, but overall the market seems to be holding fairly steady. So looking at our results, hopefully everybody can see it on the screen. Overall, this number 2 provided tax input on tax matters only, but not really part of the overall PMI team, was the leading vote getter, which I think is probably consistent with our experience. With that, Joe, why don't you lead us in a discussion about working with PMI teams?
Thank you, Scott. That is interesting. The polling results are also consistent with my experience with tax departments. So that's helpful. It's how we framed our presentation today. So that's good. So quick introduction from me. I lead the M&A consulting team for tax in the Australian practice. And I spend a lot of time as a tax SME within broader PMOs and IMOs in a post-transaction setting. So I've been asked to share some insights from my experience and talk to 2 aspects of tax PMI. The first is identifying tax synergies that are achievable from participating in cross-functional integration teams. And I'll provide some examples of where tax departments were able to create value for the transaction and making the case for tax involvement. And the second topic for me is tax planning with respect to planned divestitures and carve-outs. Again, I'll share some insights of how tax departments might manage these. So we'll start with tax synergies. Scott covered at a high level what we mean by PMI and why it's important for tax to be involved in PMO, IMO for an organisation. We call it being integrated with the integration. So for context, I wanted to briefly cover the way we approach these integrations at Deloitte, and that's captured in the slide that's on your screen. As Scott noted, tax departments are typically interdependent across every function within an organisation, and this is especially important in order to achieve a successful integration. There are a range of considerations for the tax department, and all of these affect multiple work streams across the organisation. Some of the main ones are listed on the slide in front of you, but we'll go through some of these in a bit of detail. And ultimately, this is why your PMO must be across tax, and this is typically achieved by having the tax department involved in the PMO. I should point out that this slide also captures the various stages of the integration lifecycle, and you can see that at the bottom of the slide, where you see operating model initiation, blueprinting, day one readiness, and then stabilisation. For today's presentation, we're focusing specifically on that last stage, which is about benefits realisation and value creation, which aligns to the broader theme of today's debrief session. If we could go to the next slide, please. This slide provides a bit more detail in respect to the cross-functional dependencies relevant to the tax department. We would use this to consider key decisions where the tax department should have input. So for today's session, I want to talk specifically about tax considerations in respect to 2 of these areas. The first being the operating model, and the second being IT systems. I won't cover the obvious tax work stream because all of you should be familiar with this already. So managing tax strategies, global effective tax rates, etc. But for context, you can see where those would fit. So I'll kick off with the operating model. So most people know that this is one of the standard synergy plays in integration, and especially the case in a typical acquisition scenario. Broadly, this is about how to bring together the operating models of 2 or more businesses, so as to not simply double up on common functions post-acquisition. And it's important to acknowledge that finance, and in this context, tax will typically sit as part of a finance team in almost any benchmark efficient structure. The deal team will have factored in synergies, which these days is anywhere from 30%, which is almost the standard minimum, to as much as 80 to 90%, which is somewhat aggressive, but that's essentially removing the cost of an entire finance team. So in this context, and with tax departments in mind, I wanted to make a couple of points. So the first one is that these things are usually driven by a standard benchmark analysis. And ultimately that is, what does a similar size organisation's tax department look like and how much does it cost? As a tax department going through this process, it's really important to understand this benchmark and where it comes from and whether it's realistic. Noting that for tax, there's usually a range of complications that are not well understood by the finance teams or the deal teams. And so sometimes those comparables that they find as standard benchmarks may not be appropriate. So that's something to bear in mind. Also pointing out that in almost every transaction I've been part of, the tax functions appear expensive in the context of benchmarks. And that's typically because there's less people, but they're generally more senior, have more experience, and therefore are more expensive. And tax functions tend to be less autonomous in that the information that tax departments need to come from other parts of the business. So tax doesn't typically own the source data in that context. So again, it's a point of differentiation for tax teams. And maybe the final point there is in looking at what a tax target operating model should be, it's important to capture all the value drivers, not just the ones that finance or others can see. So tax tends to focus on deliverables, so things like tax returns, tax payments, and other compliance matters. But people often don't see what sits behind all of that. So the strategy, the balancing of historic risks and tax benefits and attributes and those sorts of things. So being mindful of all of the value drivers in tax, I think, is important. And maybe an overall takeaway about operating models is that tax departments need to be involved in the PMO in order to shape and influence the discussions and decisions on target operating models. Ultimately, don't allow finance teams or management consultants to decide for you. There's a real opportunity to build and design the right tax operating model, provide input into where synergies are realistic, where they're achievable, and manage risks where there's improper processes in place. Okay, so IT systems. I'll go into IT systems now. Perhaps one of the largest and most time-consuming projects that come from integration is with regard to ERPs and other technology platforms. People typically understand these to be for things like ERP implementations or alignments of ERPs, or it could just be one integrating into another. But relevant to a tax department, this is one of the areas where the tax department is not part of the initial design phase. It's often not consulted. And if we're fair about things, tax departments usually don't have any spare resources to be involved in a meaningful way in any case. But a consequence of not being part of the design phase is the tax departments inherit somewhat generic systems. And that's noting that most ERPs have fairly generic finance and reporting modules, which leads to tax departments usually creating for themselves additional processes or workarounds in order to achieve the types of reporting that tax departments need to do. This is inherently more labour intensive and over time, more so, but also prone to errors and inconsistencies. So I think the point I want to make here is that typically tax departments tend to make do with whatever the work stream comes up with. But I think there's two good reasons to invest some time here. The first is about creating efficiencies. This relates to my point before about operating models. When you look at making the tax operating model more efficient, one of the solutions that people talk about is to build up an improved IT system. which essentially means you can't rely on the workarounds and the tax-only reconciliations and tools that tax departments often prepare. So instead have these built into the design requirements for the ERP. And when they're building up the finance and reporting modules, have those included from a tax point of view. The second good reason is I think this is just where tax authorities are moving these days. Just about every tax jurisdiction is seeking more and more data from taxpayers. A good example these days is in relation to Pillar 2. You would all see the volume of data that you need to analyse and process to carry out the effective tax rate calcs and those sorts of things. There's a real opportunity to build a lot of that into the ERP and leverage the finance team who are already using IT systems for their various reporting. So that's something to consider. And a final point in relation to tax synergies. I think we'd encourage tax departments to focus beyond the usual outcomes of good tax planning and management. So things like effective tax rates and efficient profit repatriation, retaining and enhancing tax attributes, those sorts of things. In a PMI context, synergies can be broader than those, and organisations are increasingly looking for all functions to contribute to that. So this is an opportunity to elevate the profile of tax within an organisation. And one common observation I'd share from a number of projects, every single one of these, the integration happens whether the tax department's involved or not. Decisions will get made, and like everyone else in the organisation, tax departments will end up living with the consequences of those decisions. So getting integrated with the integration gives tax departments a seat at the table. So I'll shift focus onto the second topic that I have to cover, which is tax planning with respect to planned divestitures and carve-outs. So in this context, we refer to divestments, carve-outs, demergers, and similar transactions as separations in a PMI context. Like with integrations, the key to this is good planning. A separation is an integration in reverse, but with more defined timeframes, and I'll come back to that one in a second. So for context, I'll distinguish between transactional versus operational planning. The former is typically where tax departments spend time, so you'll be familiar with that. The technical complexities of demergers, gain and loss calculations, cost-based calcs, those sorts of things. The latter, the operational planning, is where we focus in a separation context. The slide on your screen represents diagrammatically the typical timelines in the context of a separation. So most of the tax teams will be familiar with the green boxes. The key point here is that there's a need to run various processes in parallel. I want to point that out with separations. Day one often happens without the tax department or is handed over to a new team, which gives you a more defined end date, noting that day one typically has a new owner. The next slide, Perry, if we could move to the next one, is how we approach separations from a tax perspective. So it's a little bit generic, but I think this captures the way we do things. And in this context, I want to focus on what I think are maybe the two important areas for tax departments. The first is the importance of defining the tax function, which leads to developing a realistic separation plan. And the second is being involved in the carve-out financial statements, which I'm sure everyone's been part of and generally seen as a critical task. So I'll start with the tax functions and just some comments in relation to that. So in a separation, there'll be two or more tax functions. In this context, we'll refer to the parent entity and a SpinCo. Post day one, SpinCo will be a separate taxpayer owned by a different organisation and therefore will have a separate tax function. So you need to define what the tax functions are, what tax functions are required for each. And so you might consider things like whether SpinCo will become a standalone tax-paying entity, whereas it used to be part of another group, whether there's different tax attributes to think about, which of those tax attributes remain with the parent versus which ones go with SpinCo, tax payment and lodgement and compliance requirements change. The jurisdictions that the taxpayer participates in will be different potentially. In the slide in front of you, all of these considerations are captured under the heading of disentangling parent from SpinCo. And it's an area that I think tax departments need to focus on. The next part of it is to focus on the skill sets and capabilities and the resources you'll need within each business. And ultimately, this is about developing a tax operating model for each business. This is covered in under the heading of designing tax department operations in the slide in front of you. And in this context, I just want to cover kind of 3 standard approaches that tax departments usually adopt in creating the second tax function. So one is to create a clone, which is essentially replicating the existing model. So copying the parent tax function into SpinCo. This is actually the default approach we see tax departments take because it's the quickest and most efficient upfront, but over time it can be more efficient. You may be running processes that you actually don't need in SpinCo. And you may be retaining operations in parent that you don't need to retain anymore. So that's kind of the default. The other 2 that we maybe focus on a little bit more is kind of case by case. The second is where you develop a second independent tax function. It's entirely new and separate, and you build that to be case specific depending on what SpinCo does. The other is you may transfer an existing tax function from parent to SpinCo. That is relevant in certain contexts. Not that common, but it is something that happens. I'll move on to financial statements, carve-out financial statements. So when tax departments are asked to provide input into a separation, this is usually where it begins. It begins with an ask to help prepare a set of carve-out financial statements, and it's an important outcome in separation that affects many work streams, so that makes sense. I won't go into specifics about tax balances and tax reporting, so this will be quite familiar to this group. But I just want to acknowledge that this exercise is typically more complicated than most PMOs expect, and there can be quite a significant lead time for tax departments relative to the other work streams in delivering accurate and meaningful tax inputs. In my experience, this is where roadblocks and delays generally arise. And that's because finance has assumed that the tax input is straightforward when often the tax is more complex. So, for example, tax departments will need to think about new tax attributes, potentially resetting tax cost bases. There'll be deemed or actual disposals and all the calculations that go with that. A lot of those things don't arise in an accounting context. So tax departments should also be cognizant of tax payments and compliance obligations which arise in relation to SpinCo post-separation, which often don't get factored into these things. So in this sense, the carve-out financials are not as innocuous as many assume, and rather they require due consideration of entire separation transactions at quite an early stage. And you'll actually see this in the slide. It's the second chevron in the timetable. So we actually bring forward the carve-out financial statements, which is a little surprising in some ways because it's the last piece of deliverable that we generally look at because these are the day one tax balances. With that, I think that concludes my section of this presentation. So I'll hand back over to Scott, but please do raise any questions in the chat section.
Thank you. Thank you, Joe. I appreciate that. This brings us to our second polling question of the day. As you can see on your screen, based on your prior experience with PMO, IMO type teams, in your opinion, how is the tax department viewed by the other functions in regards to adding value in the process? Your options are tax department is viewed as adding significant value, tax department is viewed as adding average value, tax department is viewed as adding little to no value, or not applicable. While we're waiting for the results, let me go back to Joe real quickly. So, Joe, you had mentioned in your presentation about how things are changing. So, obviously, in the area of tax planning with BEPS, with MLI, with Pillar 1, 2, all the things coming on, it's getting more difficult to do easy tax planning in regards to saving ETR. So what are the expectations of most companies in regards to the tax department providing ETR reductions versus just providing overall operational tax support?
That's a good question. I think the ETR savings are perhaps less understood across an organisation, and there's a lot of nuance and technical support that goes into those positions. I don't think the broader organisation in the context of the PMO fully understands those, but they perhaps do understand the operational efficiencies and the cost savings there. So I think they look to the latter, although it's not to say that the ETR efficiencies are not something that you'd seek.
Okay. Thanks, Joe. Looking at the results, so good thing. The tax department, the leader was tax department is viewed as adding significant value, which I think we all hoped was the case. At 44%, followed closely by adding average value. So that's interesting. Always interesting to see how we're viewed by other functions. So thank you for that. So now let's move to William to discuss the IPTP related opportunities.
Thank you, Scott, and thank you, Joe. And now I'm going to talk about some consideration about IP value chain and supply chain planning, or together with the transfer pricing consideration today. Now let us first take a quick glance at the business model optimization life cycle from an M&A perspective. As you can see in this flow chart, a company looking for M&A transaction will go through a few stages, including formulating the expansion or investment strategies and identify the appropriate targets, carry out due diligence to identify key value drivers and risk of the target, make decision on whether to invest or acquire the target. After completing the acquisition, then carry out the post-merger integration, PMI, with the objective to optimize the business model, including, of course, the operations and structures, and to enhance the value of the whole business. So next slide, please. Integration of operations and structure requires careful consideration of various complex and interrelated aspects in order to appropriately design a business model and structure that drives tax savings and create valuable business synergies. If a mature and efficient operating model is used by one of the existing groups, integrating the other group may be less challenging. However, PMI always provides a good opportunity to re-examine the overall model for opportunity and risk. As you can see from the table below, the organization structure and strategy is always a starting point of designing the integration plan and supply chain model. For example, whether the group would like to adopt a global or regional business model, centralization or decentralization of product development and shared services, etc. After designing the initial preferred business model and integration plan, management will then have to consider the holding structure and tax consideration on the post-integrated business model and the implementation of the integration plan. For example, designing a holding structure that can minimize the interest, dividend, and royalty withholding tax costs in different countries or regions, formulate a tax-efficient asset transfer plans to minimize the direct and indirect tax costs on transfer of assets such as intellectual properties, real estate properties, and other physical assets. Consider the transfer pricing of the integrated business model, taking into account the function and risk of each of the post-integrated operating entities is equally important. Next slide, please. This slide, if you can see, is an illustrated post-integrated supply chain model of I would say, a manufacturing group. As you can see, this is usually there's usually a headquarter or hub in the middle to replace the original target group entities and centralize the sales directly to the customers or via some limited distributors to customers in countries with higher tax rates. This headquarter or regional hub will usually locate in a lower tax jurisdiction like Hong Kong or Singapore, which we usually have lower than 20% tax rate, and take up the key function and risk of the business in order to share what we call the residual profit of the whole business group. In particular, it will usually own the valuable IPs of the business. There will be various different entities also, if you see in the chart, including the contract manufacturer entity, R&D service providers, shared service centers, and distribution centers to provide various business support to this headquarter or regional hub. And they will likely be remunerated at a cost plus or even a kind of lower margin model, depending on the actual functions and types of business. So these entities could be third parties, supplier, or could be entities within the group. So next slide, please. In this slide, I have actually listed out some of the key driving factors of a PMI exercise, not just pure from a tax angle, but tax is also one of the important things. So you can see including reduction of effective tax rate, expansion to new markets, focus on some core business activities, optimizing the group structure by, for example, reducing the number of companies in the group, increasing the shareholder value via increase of both operation and tax efficiency. That is most important objective of a PMI exercise. So next slide. The holding structure optimization, this is more from a tax efficient angle. So when we consider PMI, holding structure is always important factors, so should be considered at early stage of the M&A process. So having appropriate holding structure can help to minimize the effective tax rate of the whole group. I believe everyone will agree. So reducing the withholding tax on dividends and intra-group interest via applicable tax treaties. So, but having said that, other consideration is required to be taken into account in designing the holding structure. So including like the substance requirement to obtain a certificate of residency in various countries, and satisfying the beneficial ownership requirement to enjoy tax benefit in certain countries, and also taking into account also the latest what we call the BEPS policy, including Pillar 1 and Pillar 2, and also the thin capitalization rules, control foreign current corporations legislation in various countries. All these factors has to be taken into account in designing the appropriate holding structures, so to make a PMI supply chain model effective. So next slide, please. So it's quite common for the PMI exercise to involve transfer of business or shares of companies. So in order to avoid challenge by local tax authorities from transfer pricing as perspective, it is important to effect the transaction with arm's length principle. So in particular, the group should determine the fair value of the business being transferred and taking into account both tangible and intangible assets, such as human capital, marketing channels, technologies, customer list, goodwill, etc. So major transactions which require detailed valuations or transfer pricing analysis, including the valuation of those shares and intangible assets to be transferred. Of course, also the future royalty rates or license fees to be charged between group companies, and interest rate on intercompany financing transactions, etc. So proper transfer pricing documentation should always be prepared to support the aforementioned transactions. Okay, next slide, please. Oh, these few slides, I'm taking you through two case studies today to illustrate the tax benefit of PMI. So for this first case study, the target group is a highly profitable full-fledged manufacturer and distributor of industrial equipment. This Japan full-fledged manufacturer has developed and owned all IPs, does all the manufacturing, and is responsible for managing the global customer relationship, which contribute actually 75% of the group business. So its global revenue is quite high, $3 billion US dollar. It has a group trading company in Hong Kong, which buy the products from the full-fledged manufacturer and then let the full-fledged manufacturer to earn a cost plus 5% margin only. And this operating model has been operated for quite a number of years, more than 10 years. So next slide, please. So of course, if you are a tax person, you clearly see there's some problem in this target group. So during the due diligence, of course, we identified that there's Japan tax transfer pricing tax exposure here because the Hong Kong trading company is taking all the profits, and but the IPs and relationship management of global customer are rest with the Japan manufacturer. So in that sense, we believe the Japan Tax Authority could challenge this case, and the exposure we are talking about are quite significant. Therefore, at that time, it was quite a number of years ago. There was still no tax treaty between Hong Kong and China and Japan. So that's why we cannot leverage on the mutual agreement procedures as well. But even though, if you look at this case, even though you have a treaty between Hong Kong and Japan, I think it's still in this kind of fact pattern, it's still difficult to obtain an MAP if the Hong Kong company continue to retain such a high margin. So next slide, please. So given you can see this target is quite attractable to our client who is the acquirer in Hong Kong. They still actually take the tax risk and purchase this target. So then PMI clicks in. So we suggest we have provided a tax planning idea for the clients. First, to transfer the IP from the Japan manufacturer to the Hong Kong acquirer, which is the holding company now. And also, but of course, when you transfer this IP out, then valuation should be carried out to determine the arm's length consideration on transferring the IP to avoid Japan Tax Authority challenge. So secondly, we have arranged, suggest a client to have the Japan full-fledged manufacturer to charge a service fee to the Hong Kong group trading company for handling the customer relationship. So, and also, we also suggest a client to, if possible, to convert the full-fledged manufacturer into a contract manufacturer in the future to reduce further reduce its share of profits, given it will not own the IP, and also for the customer relationship, they are charging arm's length fees already. So after implementing this idea, the Hong Kong group trading company can gain, it's more justifiable to earn the residual profits because the IP owner is no longer the Japan company. But then having said that, substance, of course, should be established with the IP owner in Hong Kong to what we call, usually from a transfer pricing perspective, we call the DEMP function, right? The development, exploration, and maintenance of the IP should be done in Hong Kong as well to ensure this tax planning idea does work from an overall perspective. Okay, let's move to a second case study. Target the company, which is a Singapore technology company, has through acquisition over the past 10 years. So they have obtained IP planning advice in the past from external advisor to transfer the IP to a Ireland IP code. The Ireland IP code will charge 5% royalties to each of the subsidiaries in various countries like US, Germany, Singapore, China. And the Singapore and China entity provide R&D services to this Ireland IP code. Next slide, please. So, of course, during our due diligence review, as you can see, the Ireland IP code doesn't have much substance there. So our US and German tax team say that the IP code, there's a risk that the IP royalty expense cannot be deductible. There's one reason, because when the Singapore company transferred the IP code to the Ireland IP code, the Ireland IP code actually did not make any payment to the Singapore IP code. So therefore, this increased the risk that whether the Ireland IP code is really owning the IP, because they actually didn't make any payment to acquire this IP. So the additional tax exposure is talking about $50 million per year, so which is quite high. So in addition, we understand that there's the R&D agreement in place between, the service agreement in place between Ireland Co. and Singapore and China group entities. In the past 5 years, the R&D expense was not actually paid by the Ireland IP Co., but instead, 2 out of the 5 years was paid by the US and Germany company to the China and Singapore entity. And the remaining 3 years, actually, the R&D service fee was not actually paid at all. So you can see the tax authorities in various countries may consider this IP is actually partially funded locally by the US and German entity. So therefore, the deduction is, of course, definitely at risk at that stage. Okay, next slide, please. So in order to manage this IP-related tax exposure, because our clients still acquired the business, I think the technology is quite attractive to our client. So it's a Singapore acquirer. You can see they still acquire the business. And then we suggest the client to have to do something as a PMI angle to avoid future tax risk. So we have suggested them to transfer the IP back to a Singapore principal company, so that the Singapore company at that time, I understand from the Singapore tax team, is that this principal company can enjoy a lower tax rate and preferential tax treatment, and it will act as the headquarters for making sales to various different countries, of course, or via some limited risk distributing company in other countries like US or Germany, and so they own lower profits. And then the trading of the income, the residual profit, will rest with this principal Singapore company. So this planning idea, of course, again, the transferring of IP has to be in arm's length. And also in future, also transfer pricing study need to be performed between the principal company Singapore and various countries like US and Germany as well, to justify and prepare the GP documentation as well. So next slide, please. So to summarize, the lesson learned from these 2 cases so includes the following. You can see. So has the target company addressed key transfer pricing issue that can potentially give rise to significant tax liabilities? Is the form and substance aligned and backed by contracts? So what are the key value drivers of the IP in the business, and who are the economic owners? So have all intercompany transactions been identified and paid for? Has there been share issuance and have been adequately due diligence on the valuation of the shares as well? So what are the possible remedies available to mitigate TP-related disputes? So let's now move to Scott for a discussion on the legal entity rationalizations. Thank you, Scott.
Thank you, William. We appreciate your time on that. We'll go on to a little discussion about the legal entity rationalization. So as you can see on the screen, one of the negative side effects of mergers and acquisition activity in recent years is it often leads to inefficient and complex legal entity structures. These complex structures tend to drive up the costs across the enterprise. So it's little wonder that cost reduction is perhaps the most common driver for legal entity rationalization efforts. But to achieve these cost savings, the enterprise must embark on a entity rationalization project. And these projects, to be honest, can be take a lot of time and cost a significant amount. So company leadership will often demand an estimate of the potential cost savings before authorizing such a large effort. In the past, many companies just relied on a rule of thumb regarding cost savings, just an estimate, say 20 or 50,000 or whatever per legal entity. However, such high-level estimates are often poor indicators of actual results. It should be further noted that pre-tax cost savings are not the only savings and only benefits that can be achieved from an entity rationalization project. Other benefits that enterprises can derive include risk reduction. So that's from the alignment of the legal entities with the company's business model that can increase the likelihood of using the correct legal entity for contracting, employment, etc. And having fewer entities can also make it easier to generate accurate separate company legal financial statements, which are necessary to produce the correct tax provisions. And also can provide ease in doing business. Having fewer legal entities can make it both easier for customers and vendors to do business with our enterprise, especially if a particular customer or vendor must routinely interact with multiple entities across our enterprise. And finally, there's obviously tax expense reductions. Additional legal entities can trap tax losses or other tax attributes, causing an overall group to have a higher than expected effective tax rate. For example, if the group's third-party debt is sitting at the parent company and the profitable operations are at the subsidiary level, many countries will not allow the parent's interest expense to offset the subsidiary's profits, resulting in loss carryforwards at the parent level, but full taxation at the subsidiary level. So one other consideration to make when estimating cost savings on a per entity basis is the amounts that can vary widely, as they can vary so widely that they become meaningless. For example, in the US, you may have an entity, but it only costs a few $100s to maintain each year, as there's no requirement for a statutory audit or separate tax return, etc. On the other hand, the cost to maintain a duplicative operating entity in, let's say, Europe, can cost several $100,000 per year. So attempts to estimate cost savings based solely on the number of legal entities that can be eliminated usually end in frustration unless we fully consider the location of the entity, the activity of the entity, the level of rationalization, meaning are the entity's activities fully absorbed in another entity, or are they just continuing to exist separately within that surviving entity, and other factors such as results of prior integration projects. Moving to the next slide, there are also other savings that can be achieved. You can see here on the slide, there's several different areas. Legal and regulatory, you can reduce fees and costs relating to minimum taxes, licensing, permits, registrations, registered agents, public notices, that type of things. Finance and treasury can see a reduction in bank account service fees, transaction charges, capital costs associated with minimum deposit requirements, debt covenant compliance, etc. The accounting side can also see reductions in fees relating to statutory audits, redundant or inefficient shared services, monthly and quarterly annual reporting, intercompany accounting between the multiple entities, and those type of items. On the operation side, you can see reductions that can be result from the duplicative model being shared, misalignment of the operational model, duplicative things like insurance policies, those type of things. And on the IT, obviously, as Joe had talked about, integration in the IT can reduce costs related to IT systems, general ledger integrations, input, consistent configurations, those type of things. And finally, HR reductions can be achieved through administration and shared services, insurance premiums, vendor rationalization, those type of things. In the interest of time, we'll skip ahead a couple slides to a case study, just to kind of give you an example. In the last couple of years, one more slide, Perry. So a couple of years ago, I was involved in an LER project. As you can see from the slide, it was a consolidated group, approximately 120 entities throughout the world, 50 plus countries, was acquiring a smaller group, but not really small. It was 40 entities across 25 countries, and only 5 of those the acquired entities were in new jurisdictions. So there was multiple entities in several jurisdictions. Well, the company undertook a project to reduce the then 160 entities down to approximately 100. That included the combination of some existing legacy entities that they felt could be reduced. The company estimated hard annual savings, and this would be, as we talked about, stat audits, tax compliance, global audits, those type of things, was about $100,000 a year. with additional savings potential in headcount, controls, treasury, those type of items. And the project was expected to take 1 to 2 years to complete. While every company is different, this company, some of the key learnings that we were able to see was, tax considerations. Honestly, the tax considerations, NOL planning, making sure the debt was in the right place was actually probably the easiest part of the project. The number one reason why some entities were not able to be eliminated actually related to HR type items, work council negotiations, matching benefits. Different entities from different groups had different benefits, and the company the cost of matching those benefits, at least initially, was too high for them to remove some of those entities. And that should be noted that the IT was a big issue in many cases. We saw a lot of systems not talking to each other type situations, so the IT had to be deeply involved in the integrations and the eliminations of entities. And finally, the legal side, some things that maybe the company didn't think were going to be difficult actually ended up taking longer than expected. Things as simple as being qualified, a new entity being qualified as a vendor for a customer. Some of the know your customer type obligations took longer than needed. So at the end of the day, most of these entities were able to be eliminated. It did take a little longer than expected, but I guess the key points were, be patient. The projects are of value. There are tools out there, Deloitte, and as well as internal tools. There's certainly that have the process, mapping out the process, planning carefully, and be organized. And these type of projects can result, as we said in this one, the ending expense savings was actually more than $100,000 per entity. So if you go across 60 entities, that's $6 million a year. So there is savings to be had, but they are not projects for the faint of heart. It does involve a lot of countries, a lot of roles, a lot of disciplines that need to be done. So they certainly can yield substantial benefits for the companies. But obviously, before embarking on such a project, it's important to estimate the cost, but also the benefit and the likelihood of success of combining some of these entities together. So that leads us to the end of our prepared discussion for today. Let me see if we have any questions. We do have, it looks like, 1 or 2 questions here that we'll go into. First question, let me throw it to you, Joe. It says, our tax group has not historically been heavily involved in PMI integrations. Do you have any recommendations as to how best to get the tax department involved?
Thanks, Scott. That's a good question. Unfortunately, there's no sort of black and white answer to that, right? So like anything, it's working through the organizational channels, conversations with CFO, etc. I think being able to demonstrate where the potential synergies are is probably a good angle. And as I think I touched on before, not just around effective tax rate considerations, but cost synergy type considerations. But yeah, unfortunately, no easy answer to that one.
Okay, thanks, Joe. And then we have one final question. The question is, what do you recommend when the tax department and the operational groups such as HR, IT have different thoughts as to how best to integrate? I'll take that one. I've seen that several times. We were just on a project just last year where there was pretty significant differences between what the HR department wanted to do for some of the stock plans and the tax implications that were significant if they did it that way. At the end of the day, as Joan mentioned, you kind of just have to get together. In this case, we did have a steering committee that sat over the whole PMO process, and they were able to quantify the benefits from the HR perspective as well as the cost from a tax perspective for doing it a little less than efficient ways. and ultimately the decision was made by the steering committee and the CFO and the CRO of the CHRO of the company. So, I would recommend that you speak up. Don't be unwilling to say what you think or mention it. Obviously, tax department, even though I would like to think they run the company or should run the company, obviously we provide input, and if we work together with our colleagues, that we can usually achieve a result that is beneficial to everybody. So looks like I actually had one more question that came up. I'll read it. It says, what is the most complex and challenging task in an M&A integration? Transfer of IP and aligning the operational model. On the transfer of IP, is it linked to the acquisition price? So I don't know, Joe, if you can, what have you seen as the most complex and challenging risk in maybe an operational IP or aligning an operational type model?
I think so. Normally with these integrations, they're challenging as they are without additional complexity. So sometimes transactions are maybe not heavily driven by tax advantages and benefits, but maybe more than usual consideration to tax benefits. In those situations, I think tax becomes key to setting up the operating model. And this goes to a lot of what William was talking about in his session. It's making sure that the tax outcomes you want from a transfer pricing point of view are reflected commercially, as opposed to tax-only adjustments after the fact. And so I'd say that is, from my experience, really challenging structures where they're tax-driven. Not that we'd ever admit that that's what they were, but where tax benefits clearly drove transaction value is where we find the conversations most intense.
Thanks, Joe. And we do have a few minutes left, so we have one more that popped up. The question is, what kind of long-term benefits may be forfeited if the number of entities is reduced? It's an interesting question. So, obviously you have to consider everything when you get rid of or reduce an entity. There's legal liabilities. If you merge the entities, how do you get rid of that legal liability? Does it move over to a new entity? As far as long-term benefits, the thing that I've seen is sometimes probably that may be forfeited is sometimes the institutional knowledge. Unfortunately, or I guess fortunately, sometimes when you combine entities, it leads to duplicative headcount, and some people end up moving on to other companies. And so sometimes the long-term institutional knowledge is lost if it's not transferred effectively. But overall, I don't think there's a lot of long-term benefits that can be forfeited in rationalizing your entities if it's done efficiently and with care. So that's all we have in questions today, and it looks like we're nearly out of time. So I want to first of all thank Joe and William. Thank you very much for presenting today, and I want a special thanks to all of you that were able to join us. We'd like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you did join us late, please note that the presentation is archived for future viewing. And if you feel others would benefit from this webcast, please share the webcast via the share this icon or have them visit the Deloitte Debriefs website. If we have any additional questions, we'll be happy to respond to those, or you're welcome to contact us directly. We're happy to talk to you at any time. With that, thank you from all of us at Deloitte. Again, thank you for participation, and we look forward to having you join our next Deloitte Debriefs broadcast. Thank you and goodbye.